Thank you, Dr. Cho, for the introductions. And I don't know which language I'm supposed to speak for these presentations. If you want Korean, then I can speak Chinese. If you want English, then probably I can speak Spanish. And so I don't know which one is more comfortable for you guys, but I will speak maybe Russian. So this paper is a joint work with Luz Killian at the University of Michigan, and the usual claim is applies. And I'm supposed to say to read by this view, blah, 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 but I just want to save time. So this is my own view. It has nothing to do with the DOE or Energy Information Administration. If you're looking at the history of oil price and its ups and downs, depends on all different kind of shocks or events that throughout the history. But normally when there is a shocks and then it increase or decrease the price of oil, it's not last for a long time, but however, starting from around 2003, goes up to 2008, the price has been run up to so high that the alert a lot of regulators and the policymakers what's going on out there. And then someone has to be in jail. So what they start talking about is maybe speculators drive the price. So when you're looking at the 2003 and the prices start to increase and increase until around the 135 at the real price, and they eat down to also about the $40 or $50. Whereas if you're looking at the 1990s until 2000, the price was about $25. So now that you're paying $25 and they went up to $130 or $140, and how would you feel? There was a lot of policy implications, and then they call for investigation, and then day after day, we've been testifying, investigating, and up to today, nothing has been resolved. So here is the policy questions. What caused the price? The great surge in the real price of oil from 2003 to 2008. Is that due to producers' speculations or consumers' speculation? Or speculation. What is the speculation? And then we're going to define what is the speculator, what is the speculation. It depends on. We'll define for that one. And then more important issue is when there was 2011, we have Libyan crisis, and then is there any price increase? Well, the United States or also the EU, the sanctions Iran, and what happened to Iran? Is there any price increase? And someone tell me exactly how much price has been increased or decreased due to this kind of shocks. So our motivation has not done at all, and the motivation is, can we quantify exactly? If someone asks me, the January 2008, what was the price decompositions? Is there any speculation premium? Is that a $5, $10? Tell me. That's our motivation on this paper, and then that's where we are heading to. So the natural expectation in the speculator is that someone who buys the oil today, not for consumptions, but for future use. So naturally what they do is that they go out to buy the oil, and then they store for future use and in anticipations the increasing of price. So naturally, that kind of behaviors eventually increase the demand for future oil. So here is a Killian and Murphy, the first coming Journal of Applied Econometrics, and the 2003, that they find out, well, we can quantify this kind of behavior, and we decompose all different kind of shocks. So we're looking at the data as the 1973, and we're using percent changes of global crude oil productions. And we also have the real activities and the real price of oil. And the last one is changing above ground the crude oil inventories. But obviously, there isn't any reliable data out there. especially non-OECD countries, that we talk about China and India and some other countries, there isn't any data available, but someone has to approximate what is reliable data. So using those data, we can identify the 4 different shocks: the supply, demand, and speculative demand, and then usual suspect of the idiosyncratic, the components. So here is the first assumption. To do that, we have to assume that when there is a supply shocks, then oil production is a decrease. As a result, the real price of oil increase, and then real activity is decline. And also we have the demand, the flow shocks, then all the 3 items are increased. But on the other hand, when there is the speculative demand shocks, then what happens is oil production is increased, and oil prices increase, and then inventory is increased. As a result, the real activity is decline. So this assigned restriction is really necessary to draw the admissible some kind of a result. So we have a further some restriction on the elasticity of supply is around 0, which is about the literature is suggests. And then we have the elasticity of demand. The current shock is always less than the long-term shocks or long-term elasticity. And then we have the usual, the somewhat dynamic sign, the restrictions that any kind of a shock arrived today, that's going to last about 12 months. So here is the proxy. The Killian and Murphy, they used EIA data to approximate the global inventories, and then that against the historical the events that they find out that their inventory is reliable, and the capturing all the events that 1979 we have Iran, the revolutions, 1986 when the OPEC collapsed and the price declined, and then we have 1990 when the Gulf War I arose and then price the surge, and then even 2002, 2003 we have Gulf War II or pre-invasion of Iraq. So it captures all the events that, so technically it passed their external evidence. At the same time, someone comes in, hey, if there is additional information by the futures spread, and the inventory data is not capturing all the information that you're supposed to have that information in the model, and then we have the test for information sufficiency, and then it passed also. So data is okay, but however, the empirical result is always driven by the data. Is there any way we can improve? Yes, we can. So we decide to use these papers to purchase the private information data, and that there is the group out there is called the Energy Intelligence Group, that they sell the data, and we purchase, and we against with the Killian and Murphy original data. Also, we update data up to 2012, and then see how robust our result is. So this EIG data is capturing the commercial oil stocks outside the OECD, which is the big deal that we need for global inventories. And then we have oil stock at the sea. There is a lot of component in the speculations that, well, the speculators is storing oil, and they just live on the sea and they wait and see how the price is gonna go. So tanker is not moving, and actually our area, we just sat down and the monitoring all the tanker is moving minute by minute. And then here is the oil in the transit / independent as well as strategic stocks. And a lot of the trader reports that they said that China is swatting oil under the ground, and that as a result, oil prices are increasing. Is it true? We'll find out. So the first question is, financial investors to use the tankers. As I said, that they use oil tankers to store the oil, and then they artificially increase the price. That's the number one that we need to find out. There is another one that China, they store the oil under the ground as a strategic petroleum reserve, and as a result, the oil price is increasing. Is it true? I'm not sure about that. And then finally, the Iran decisions. They can't sell the oil, so what they do is they've been dumping on the oil to the tankers and deliver on the sea. As a result, whether oil prices increase or decrease. This kind of the questions that need to be answered. So we're looking at the graph, and the bottom one, the independent in transit, there is no changes. So that is irrelevant. And then we have oil at sea, which is the black line, and it doesn't have any increase lately. So we can just disregard. Third one is, a lot of people said that China purchased the oil, and then they stored under the ground. Well, if you're looking at the dotted blue line, there wasn't any increase 2007 or 2008 in any time. So that was gone. So technically, there wasn't any kind of accusations out there didn't show on this data. So when they're looking at the change in the inventories between two different proxies, that there is the great difference. The only correlation is about 31% over the time period. However, it is emerging and increasing the later times. So we are not sure why there is the more volatile, the EIG data, but just one of the things is because when they don't have the information, that they use the rule of thumbs to fill the gaps. So that gives some kind of a trade-off of whether there has been a noise or which one is a better coverage. We have no ideas, but that's not our objective. Our objective is whether we have consistent estimates and the result. So here is our models different from the Killian and Murphy. We increased the proxies. We estimate the Killian and Murphy, and then we estimate with EIG data, and then we extend our sample up to 2012, and then we just have more assumptions, and that was the primary difference. But here is the last one is the main theme of these papers. In order to identify the specific dollar amount, we cannot use the log approximations because that is the later on to give you approximation of the dollar changes. So we can't do that, so therefore we find out the way that we can get away. So let's summarize the result. When you have the estimations, we run to 5 million. When we say the 5 million, it's a lot of the result out there. So in order just to clean up all the result, we use the 0.26 as elasticity of demand. But that is the Killian and Murphy papers, and then that is the literature is talking about that is the right one. But on the other hand, someone said, hey, if you change the elasticity of demand, what's going to happen? Well, but we have the sensitivity analysis that expand the sum of the range of the different elasticity and how this result is changed. So here is the historical decompositions. The first row is effect of the flow of supply shocks. The middle one is the flow of demand shock, and the third one is speculative demand. But if you're looking at the two different proxies, whether Killian and Murphy approximations or EIG inventory data, we have about the same directions. So it is okay to use data looking at just the graph. So here is a key policy questions. How many dollars of inflation adjusted the real price of oil must be attributed to each shocks? Is it because of supply, demand, or speculation? We have to answer that one. So we introduced two summary of statistics that never have done in our literature, and we implementing these statistics essentially compute the dollar amounts. So here is a usual model. And this is the first statistics that you have to pay attention on them. We have two different columns. The first one is, the left column is the original proxy. The right column is the EIG inventory data. There are 4 different columns on each one and each row, the number 1 to 5. Number 1 is the shock by the supply. Number 2 is the demand floor shock. Number 3 is the speculative demand shock. Number 4 is idiosyncratic shocks. Number 5 is all cumulative, the price change, the given time period. The first row is year 2003 to year 2012. So for example, the left column, number 5, the first row, it says the $65 has been changed during that time period. If you're looking at the number 2 on the first row, first column, it says $38. Second column, number 2, is $40. So technically, $38 to $40 out of $65 is due to floor demand. But our interest is the speculation, and which is the number 3 columns. And in fact, original data series is slightly down, whereas the EIG data is slightly up. But nonetheless, major contribution is coming from number 2, which is floor demand shocks. So this data is 2003 to 2012, but the real question is 2003 to 2008. What happened? Prices kept going up. The price is increased to more than $90, $95, roughly around $95. And then if you're looking at $60 out of 95, that is the demand shock. So this decomposition of the price or the shocks, we are immediately rule out the speculation has nothing to do with the increasing of price, as what are the people. And then we have the 2 different kind of the literature out there. So one is fundamental side, Lewis Killian, James Hamilton, and James Smith, and the fundamentalist is saying that there isn't any speculation impact. On the right side, there is other people. Yes, there is, but they cannot produce any kind of scientific result. So we did some kind of the sensitivity analysis, and if you're looking at 2003 and the 2012, the time period, that we have the 2 different kind of a range. One is -15 to -3, -0.15 to -0.3, the elasticity of demand. The other one is -0.2 to -0.25, but the range and the price change is not much. So it is very consistent with what we are estimating. The real contribution of this paper is here what we call the counterfactual, defined as the real price of oil minus the fitted value of the given shocks. Either there is a supply, demand, or a speculative. So the difference is what we call the counterfactual. So basically what we are saying is this one is to indicate how the real price would have evolved had one been able to replace all the realization of shocks I by 0. Well, actually there is a typo in the third row. It says a shock by 0. Shock I is missing somehow. So this counterfactual, the price is telling you whether this kind of you inquire of shocks, whether supply, the demand, or speculative shock, would actually increase the price or decrease the price. So if the counterfactual price is greater than actual price, then this kind of shock is the lower actual price, lower the price. On the other hand, if this counterfactual price is lower than the real price, then it actually raises the price on the shocks. So this is how we can identify the specific dollar amount. So this kind of presentations can answer the policy questions that did it increase by the speculator? Or we're talking about the pig oil. Is the pig oil contributing the increasing of price? And what is it? So we find out the first one is the floor demand. The second one is the floor demand. The first one is the supply. Supply didn't do anything. If you're looking at the counterfactual, the red line and the blue line, the difference is the price is actually impact. So for example, the 2008, that there is about the $45 difference. The increasing of price is $45 is due to the demand impact. On the other hand, the bottom one is our question whether there was any change in speculative demand. The graphic-wise, it did not show anything. Using EIG data is the same patterns, so we come out a little bit. There is a difference. There is like $3 or $5 difference here and there, but that was not really materialized. And 2008 to 2012, whether we are able to answer the Libyan crisis or Iraq, and we find the same thing. Due to the Libyan crisis, yes, the prices increased, but not substantially. If you're looking at the first row, yes, the price is increased marginally, but it's not what we expect. Same thing as the Iran crisis. And this kind of a pattern is also showing exactly the same as the different proxy by the EIG inventory data. So what are we telling? I'm just going to conclude that there are 5 things that we can talk about. And what are we saying is the floor demand shocks is the primary suspect increasing of price during 2003 to 2008 at that time period. Specifically speaking, that about 60% of the price increase is due to floor demand. Second, there is some evidence speculative demand, but that evidence is very small that we cannot talk about, and the increasing of price is the speculative demand. Therefore, we have to regulate, we have to minimize the trade, we have to do this, and we have to change the policy. It didn't do any help. 3, there was evidence that the Libyan crisis increased the price just slightly, not much as what other people thought. And also the Iran, and that depends on the proxy, anywhere from the $0 to $9, and virtually it did not increase much. So there was a continue of the sanctions to Iran, though without any fears the increasing of oil price. And that there was no indications that higher demand, SPR, the China SPR, the increasing of price. There wasn't any indications. So finally, there was a $20 to $23 of a price decline is due to the floor demand. So basically, whenever prices increase or decrease, the great role in the changing of price of the real oil is the floor demand. It is not the supply concern. It's not the speculators. That's what everybody is thought about. That was the final conclusions that we find out. Thank you very much.